Okay, so coming into the day. Big gap down. Daily chart. Been selling off the past 3 days. Big gap down today. Follow through. The bears want to, they want a second leg down from here and some sort of measured move, maybe from here. Bulls, they want a repeat of this and test back into here. Odds are we're going to start to go sideways, and we'll probably have to get back to 4,000, but we could easily sell off way down here before that happens. So let's look at today. Overall, trend from the open that led to a trading range, which was also a triangle, then a downside breakout. Let me do more like this. There we go. First bar of the day, big gap down. And let me catch my breath for a second. So big gap down, bar one, possible low of the day. Bulls may try for a trend from the open, but probably more likely sideways. Bar two, forcing traders to sell pretty low in a 2-bar type trading range. Probably buyers below, but bear bar closing on its low, so could easily fall somewhere down here. Doji, but not a strong buy signal bar, so scaling bulls buying lows, making money. Sellers above this bar, bar three. Bears have a second entry short, retested this close, so it's limit order market. Bulls buying, scaling in, buying new lows, scalping out, selling back where the bulls are disappointed. So bulls are disappointed here. They bought, disappointed. They'll get out break even. Bears sold, disappointed, maybe scaled in higher, getting out break even. Doji bar, another doji, another outside down bar. So the bulls aren't doing enough, but the bears also aren't doing enough. And so far, the bears are trying to get a big bear bar on the 60-minute chart. So right here, it's 9:15. Give up bar, but possible 3 pushes down, 1, 2, 3. Surprise bar, may get a second leg down. The bulls may also close back on, the bulls may get a close on its high on the next bar. The bulls want a big bull bar, closing on their high. I had to pause the video, but the bears, they want a consecutive bear bar. The bulls want a bull bar closing on its high. Consecutive bear bars, may get a measured move down. Possible. Let me redraw this real quick. So this is the 520 low, which is this low right here. Let's do that. There we go. So move back to where I was. So breakout, follow through, probably a second leg down. Bulls want a second leg trap, but bulls probably at least a micro double bottom. Outside bar, but again, probably sellers above. It's hard to, and a second leg down, although it's really hard to sell this far away from the moving average. So it's okay to be flat and just waiting for the market to develop more buying pressure or an upside breakout. Another big bear bar, but again, possible parabolic wedge, 1, 2, 3. Follow through, maybe a second leg down, but again, very climactic. 3 pushes down, parabolic wedge with this push here and here. Probably some sort of measured move down, something like that. And big sell-off, more follow-through, 20 and 60% chance the market's going to form a trading range, so it's probably going to go more sideways soon. Only 20% chance this will continue, and this is pretty climactic. So gap down, sideways, big breakout, sideways, another breakout. It's climactic. Bull bar, okay buy for the parabolic wedge, 1, 2, 3, but consecutive bull bars, we could easily get a second leg down and go a little bit higher, or excuse me, a little bit lower. Another bear bar, small follow through, big bull bar. So it's a nested wedge, 1, 2, 3, and then a smaller wedge, 1, 2, 3. Probably might be the low of the day, tight channel, but bulls, if they didn't get out of longs here, they probably got out of longs. Certainly above here, maybe as this bar was going up. Big give up bar, probably going to test the moving average. Probably going to test the moving average and go a little bit higher. So buy the close, another buy the close bar, probably getting close to 50%. Test the moving average, gap down. So we got to remember this is a big gap and a sell off. So it's basically big sell off. This is a retest of the moving average, so the market may go more sideways here than just straight up. Disappointment bar, sellers at this high, sellers at probably 50% pullback from this high. 3 consecutive bull bars, odds are we're going to go sideways up at least for a small second leg. Second leg up, possible wedge, 1, 2, 3. Trying to test the breakout point here, which it did right there. Weak follow through. Hard to buy up here, 20 gap bar, buy first bar above the moving average in the entire day. So strong selling pressure. And doji bar, but not many traders are going to sell this tight channel. So you may get this was a wedge. This might be leg 1, pullback leg 2 of the correction. And we may get back to the open of the day, which is also the open of the week, and the May 20th low. Big bear bar. Disappointed bulls, bought this close, disappointed, got out break even. Bull bar, big bear bar. Bears were able to sell this high and scale in, make money, so that's good for them. Strong enough bear bar and enough sideways, we may get a small second leg, maybe test down to here. But again, the tight channel is the problem. Bull inside bar, it's an okay buy. But bull bar, just under the moving average, not a great buy. Doji bar, so bulls buy, scale in, get out, break even. More sideways, more sideways. This is not what you want to see. And just so you know, we're also testing the open of the day. But this is not what you want to see in a strong trend. Dojis, a lot of overlap. This might be the first leg. Sideways, pull back, and then the second leg up. Breakout bar, but it's breaking out above the channel. Follow through, testing the high close. First push, second push. Well, really, it could be kind of a nested pattern, but it's a wedge top, and this might be exhaustion. 1, 2, 3. It doesn't really matter how you look at it. So if you're buying up here, your stop's down here. That's not ideal because if it's trading range, we could easily get down to here and then test up. Big bear bar, buy the closed bulls. Some would buy, disappointed. They may buy this close, buy more lower, look to get out, break even. But they may need a really, really wide stop. So again, this is the problem with buying up here. This is not ideal. 4 consecutive bear bars, always in short. Most bulls would probably get out somewhere on one of these bars or even a couple points below this. And the reason for that is risk reward. So if you're long at the high of this close stop down here, that's 1 times your risk, which is not ideal. So it's a bad risk reward at the top of trading range, which means it might be better to do the opposite. And it was. So bears sell this close, put a stop up here, betting price would get down to here. 3 consecutive bear bars. 3 consecutive bear bars, probably at least going to have at least second leg down. 4 or 5. It's always in short, but the bears have the same problem the bulls had up here. This is strong enough for a second leg down, but the risk is big. Do you really want to put a stop all the way up here? And 1 times your risk takes you down to here. That's not a great trade, but you're in the middle of the trading range. So if I just pick a high here to here, And this is what makes trading ranges frustrating. You're right in the bottom third, so you're just in the buy zone. But the problem for the bulls is most bulls don't want to buy this tight of a channel down, so they'll wait for a second leg. And small second leg down, possible final flag, big bull bar. So now we're testing this low. It's 3 pushes down, 1, 2, 3, or 1, 2, 3. Very tight channel. You also have disappointed by the closed bulls here. Maybe these a wide stop down here. They'll buy more above the bull bar, so maybe they look to get out break even, which might be somewhere around here. Big follow through bar, and then a big bull bar. So surely the market is going to race to a new high and get a measure move up. And one of the problems with today is it's really, really tempting to be hopeful and look at this day and think, okay, we've sold off for 3 days, lots of big bear bars. You know, surely the market's going to be a big bull day today. So if I buy anywhere over here or here, maybe I'll get a measured move up of the range. Well, and that's possible, but possible and not probable are not the same thing. Just because it's possible doesn't mean that it's going to happen. So if you're buying here, you got to ask yourself, what's the probability that you're going to get a measured move up? It looks really strong, and it looks like you're going to get a strong second leg, but look where you're at. Open of the day, right at it. We've tested it several times, and you're testing the low close here. This may just be vacuum. This may just be bears stepping aside here. We went higher, but ultimately bears were stepping aside and we went sideways. So it is by the close, but you have to be really, really careful because you're buying high. And as I just said a minute ago, what is your risk? You know, what are you willing to risk? Are you going to put a stop down here? If that's the case, 1 times your risk is all the way up here. And there's not a 60% chance of that. Maybe it's closer to 50-50, which means it's not a good trade. Whoops. Had the scaling turned off. Outside down bar, a reminder that the day's in a trading range. The bears, some bulls bought this low, scaled in lower. They're getting out a couple ticks below their entry price. The market's testing a little above the open of the day. It's possible wedge, or excuse me, it's possible triangle. Something like that. So maybe we'll go a little bit higher and test this part up here. Tried to buy the closed bulls, disappointed, trying to get out break even. Then they're disappointed, going lower, going lower. And another problem right here is stop placement. There's a video out talks about this, I forget. Maybe it's in the scaling in video, but it's a similar setup where trader, and it's probably scaling in, I would start right there if you want to find it, but traders, what he mentions is, you know, there's always a way to, if you do something reasonable, you can usually avoid a loss. And what a lot of traders will do, you can buy this close and put a stop down here, but the problem with that is this situation. Well, I gotta zoom in, I gotta go a little further back, a little further down the road here, but if you put your stop down here, price may just go below it and then turn back up. So maybe the better stop placement is all the way down here. That is what's frustrating and difficult with trading ranges, is that you may need a stop much lower than you think, and you're really better off buying at your original stop. So if your stop's here, you're better off buying down here. Bulls buying down here just in case it goes up, and putting a stop down here. But I'll cover that in a minute. So that's the other problem, is you don't want to sell out of a long right in the bottom of the buy zone, if that makes sense. It's the same logic as you don't want to be short down here or hold short and get out on a stop 1 tick above here, because the odds are it's going to go sideways. Just as you don't want to be long from down here and get out down here, because the odds are it's going to go sideways up. So that's why most bulls should get out below that bar if they are long. 3 consecutive bear bars, but again, this is the classic problem of trading ranges. If you're selling and your stop's up here, it's bad risk reward. You're selling at the bottom of the range. We reversed up here, we're probably going to reverse up here. And even if we get to a new low, that's not a great risk reward. It's also possible, I forgot to mention, this is the triangle. So here, trying to keep mine consistent with the owls in his trading room. So blue lines, we may reverse up here, may fall a little bit below. And in broad, this is basically, you can call it a trading range, you can call it a broad channel. Broad channels and trading ranges always go below minor higher lows and go above minor lower highs. So we may go below here and turn back up. Not a good buy after this many bull bars. Doji bar, probably going more sideways. You know, it's a wedge, 1, 2, 3, and if you look at a 2-minute chart, Al mentioned it's a reasonable buy on a 2-minute chart, but most people should not be watching 2-minute charts. So you can buy if you can use a wide stop, but again, that's not ideal. Turning up, but again, more of a reminder of trading range price action, bears selling, scaling in, making money, bulls buying below, sold this high, sold up here, made money. Bulls, maybe they'll buy again down here, but ultimately they may buy here and just scale in, which they made money right there. But that's really difficult to do. And overall, the market just sold back to the low of the day. And maybe you had some sort of broader channel that was tested. So key things about today. The first one is in the trading range. When you look to the left and see bars to the left, it's trading range. So it's important not to be hopeful here that you're going to break to the upside. And the reason people are hopeful is because they often miss this move, or maybe they don't get as much as they want. And then they're thinking, darn, I've missed all this move. Now it's going to race to the upside. Well, the smart traders, or the institutions, if you will, they're taking profits here. They've been long, they're taking profits up here, and it's the same thing with traders down here. They went short early, and now they're taking their final portions of profits. So today's a great reminder to really not buy too high. Don't buy this. Don't sell down here. Don't sell here. Unfortunately, trading ranges, it's best to do the opposite. And most bars aren't that clear when it comes to sell the close. And you can sell the close if you can get out really, really quickly. So, I hope this video helps.